You've poured everything into your business. You see the potential, your customers love what you do, and you know you're on the edge of something big. Yet the one institution that's supposed to fuel growth just told you no. And the worst part is the confusion. You start to second guess every decision. Is my business not good enough? Did I do something wrong? Here's the secret they don't tell you in that cold, formal decline letter. For most growing businesses, getting denied has nothing to do with your potential. It has to do with an old, rigid playbook that banks use to protect themselves. They built 5 walls around their money, and if your business doesn't fit their perfect little box, you're locked out. But most people don't know this. Once you understand these 5 walls, you stop seeing it as your failure and start seeing it for what it is, a game with hidden rules. And today, I'm going to show you how to win it. The first wall, the 2-year catch-22. The first wall you'll hit is a time wall. You walk into a bank and one of the first questions they'll ask is, how long have you been in business? For most conventional lenders, including those that offer SBA loans, the magic number is 2. They want to see 2 full years of business tax returns to prove you're not just a fleeting idea. And from their perspective, this makes sense. They aren't in the business of taking risks. They are in the business of managing them. And a 2-year track record shows them that you survived the most dangerous part of a business's life. It tells them you have a history, a pattern of generating revenue, and some level of stability. But this creates a brutal catch-22 for entrepreneurs. You need capital to survive those first 2 years, to hire, to market, and to build the very stability the bank wants you to see. Yet, you can't get that capital until you've already survived. It's a frustrating paradox where the bank is willing to fund a proven business but is unwilling to help you become one. You're left to fund the riskiest phase all on your own. If you're still standing after 2 years, only then will they open the door, maybe. But even if you make it past that first wall, another, more confusing one is waiting right behind it. The second wall, the profitability trap. This is the wall that feels like a punishment for your growing business the right way. It's called the profit wall. When a bank looks at your financials, they're not just looking at your sales. They're looking at your net profitability. They use a specific formula called a debt service coverage ratio, or DSCR. It sounds complicated, but the idea is real simple. Lenders want to see that for every $1 you have in annual debt payments, your business is generating at least $1.25 in profit to cover it. A ratio of $1.25 or higher tells them you have a safe cushion. Here's the trap. As a smart business owner, you're not hoarding your profits. You are reinvesting them. You hire a new salesperson. You launch a new marketing campaign. You upgrade your technology to be more efficient. Every one of those wise investments shows up on your profit and loss statement as an expense, and every expense lowers your net profitability on paper. So, while you're building a stronger, faster, more valuable company for the future, the bank's formula only sees a business with low profits today. Your story is one of growth and ambition, but your numbers tell a story of low profitability that can't clear their 1.25 hurdle. You get punished for playing the long game. The third wall, the asset and credit barrier. Let's say you've been in business for over 2 years and you've managed to show some profit. The next wall you face is the asset wall. A bank needs a backup plan. They call it collateral. If your business can't pay back the loan, they need some sort of physical asset they can seize and sell to get the money back. We're talking about things like commercial real estate, your home, heavy equipment, or a massive book of commercial receivables, or your clients. This model was designed for an old school industrial economy. But what if you run a modern business, a marketing agency, a software company, or an e-commerce brand? Those kind of companies do not have a factory full of machinery. Your biggest assets are your code, your brand, and your team. A bank can't put a lien on your brand. So for many of today's fastest growing companies, this collateral requirement is an immediate dead end. And tied directly to this is your credit, especially in the early years. The bank isn't just lending to your business, they're lending to you. They will pull your personal credit score. And for most conventional loans, you'll need a score of at least at least 650 to even be considered. One mistake from your past, one late payment from years ago, all of those things can be enough for them to decide your business's future isn't a risk worth taking. The fourth wall, the paperwork marathon. If you manage to clear the first 3 walls, you now face the most draining one of all, the paperwork wall. Applying for a conventional business loan certainly isn't a simple form. It's a marathon. They will ask you for a mountain of documents. You'll need a detailed business plan, your articles of incorporation, and all your business licenses. And that's just to get started. After that comes the financial deep dive. 2 to 3 years of both personal and business tax returns, up to the minute profit and loss statements, balance sheets, cash flow projections, personal finance statement, and a detailed schedule of every single debt you owe. You'll spend weeks gathering, organizing, and submitting this paperwork, pulling your focus away from what you should be doing, running your business. And after all that work, the waiting begins. The average approval to funding timeline for an SBA loan through a conventional bank is not days or weeks, it's 60 to 90 days. Think about that. The opportunity you need capital for right now, to buy inventory for a big order or to hire a key employee, will be long gone in 3 months. The process itself is so slow that it can kill the very opportunity you needed the money to seize in the first place. The key, building a bridge over the walls. So you have the time wall, the profit wall, the asset wall, and the paperwork wall. It feels impossible, and getting conventional financing nearly is. It feels like the system is designed to keep you out. But what if you didn't have to break down those walls? What if you can build a bridge over them? This is where alternative financing comes into play, and it becomes a strategic tool, not a last resort. It's the bridge that helps you build a bankable business. To get over these walls, you can use a tool like revenue-based financing or working capital loans. These funders are going to look at your top line sales a lot more than your bottom line profit. They provide you with capital today in exchange for a small percentage of your future revenue that'll be paid through fixed weekly payments. Because payments are tied to your sales, it's a flexible way to get growth capital without being punished for reinvesting into your business. So to get over the asset, credit, and paperwork walls, you can use alternative financing. This is where the rules completely change. For example, revenue-based financing doesn't look at your hard assets like banks do. It's backed by your financial performance, not any collateral. It often relies on your daily cash flow and sales data, not just your personal or business credit score. And instead of the mountain of documents and 3-month wait, the applications are super simple, data-driven, and they can be approved and funded in as little as 24 to 48 hours with minimal documentation. Using these tools strategically allows you to operate, grow, and build a 2-year track record of stable financials that the bank needs to see. You are consciously building your business into an entity that checks all their little boxes. You're not just hoping for an approval anymore. You're building your way to one. Here's your path to getting funded. You don't have to feel stuck. You don't have to let a bank's outdated rulebook decide your future either. The game has changed. You can stop playing checkers and you can start playing chess. You can use strategic capital to build your bridge to the bank, moving with precision, not panic. Now, you have a few options. You can try to do this all yourself, risking very costly mistakes and wasting valuable time. Or you can get a clear roadmap. If you click the link below, you can book a call with my team. We will underwrite your file from scratch and give you a customized funding blueprint for free. We'll break down exactly where you stand in your funding journey, identify your immediate capital opportunities, and map out your next 12 months of strategic funding moves. There is no pitch, there is no pressure, just a clear path to get the capital your business deserves. Every day you operate without a clear funding strategy is a day your competitors are gaining ground. Don't let another opportunity pass you by. Let's build the bridge together.